In today's episode, I speak with a veteran in the asset-based lending business, Mark Wilk. Mark has provided financing to Canadian middle market companies for over 30 years, working at several Canadian banks before making the switch over to the alternative credit sector, where for the last 15 years he has sourced and structured ABL loans. He is a deal maker and rainmaker, having worked on billions of dollars worth of transactions, and he has focused his expertise in the alternative credit sector, dealing primarily with non-traditional borrowers and underperforming credit scenarios. We go into detail on how Mark evaluates companies from a credit underwriting perspective and what to do when a loan starts to underperform. Mark also shares his tips on how to have a successful career in the ABL sector and originate business. It's amazing to see someone with so much energy and passion for lending 30 years later. He truly loves ABL and is very good at what he does. Unlike traditional bank lending, the alternative ABL market is the Wild West and requires creativity, skill, and guts to succeed over the long term. Mark has since started his own advisory practice where he leverages his 30 plus years of experience to help companies raise financing and restructure their credit. So without further ado, here's my conversation with Mark Wilk, president of Wilk Capital Group. Welcome to the Inside Commercial Banking Podcast. This podcast is for commercial bankers that are in the business of lending money. My mission is to empower the commercial banking community by sharing best practices and the secrets to success through interviews with rainmakers and deal makers in the sector to help you fast track your career and achieve long-term success. My name is Robert Bezet, and I started my career in the commercial banking sector. Today, I'm a middle market M&A advisor helping Canadian companies sell. Thank you for listening to this podcast, and be sure to check out my YouTube channel, Finance Kid, for more content on commercial banking and M&A related topics. So let's jump into today's episode. Mark, how are you?
I'm good, thank you.
Fantastic. Thanks for making the time. I'm really excited to interview you today. You're an absolute deal junkie, deal maker, rainmaker, 30 years in the business, and you've seen a ton of deals. So let's start off by understanding a little bit about what you do today.
So after a long time being in the lender chair at a number of different places, I exited my last fund a little over 2 years ago. One of the things that I've found is because I'm fairly well known in Canada for doing distressed debt, I continue to get calls. And so it just seemed to make sense to monetize relationships. So what I've been doing primarily over the last 2 years is I take on roles to assist companies typically with refinancing their balance sheets. And that can range from, as we were just speaking before we started this, I've got one now for just under $100 million that I was brought in, 3-bank syndicate. The company needed to hire a financing advisor. And today was acceptance of term sheet, which was very excited. And so basically my focus is finding financing sources, and we can talk about the Canadian landscape, primarily in the US for Canadian companies which just don't fit within the traditional banking model anymore, especially during our current sort of economic times that we're in right now.
It sounds like you're quite busy. So I'm excited to hear your journey and how you got to where you are today. So maybe let's take a step back and understand the start of your career. How'd you break into commercial banking?
So when I graduated a long time ago, which is why I have gray hair, I came out and I really liked people. So I went and got myself my stockbroker's license. So I worked for a financial planning firm. And my best day, I made a couple $1,000s and then didn't make a nickel for the next couple of weeks. 100% commission work. I always wanted to go back and get my computer science degree. That I was enticed to join a startup technology firm. So I joined it. It was in the financial space. Very interesting. Sweat equity. I wrote the manual. I was the help desk. I was chief marketing officer. I did everything for this firm. And that was a lot of fun until the 2 primaries that were funding it just decided they wanted to go in a different direction. So then I joined Bank of Montreal. I started off a long time ago as a financial analyst in their corporate group. The girlfriend of one of my buddies that I did my MBA with was working there. So she got me in the door. I had the choice of corporate versus commercial, and I decided to go into commercial lending. I was there for about 5 years doing all sorts of interesting transactions. That was when I first learned the initial stages of credit and working within Bank of Montreal. Great place, great people. And then I was enticed to join the asset-based lending group of National Bank of Canada. So this was the first National Bank had bought a group out of the US. So it was weird. I was living here, working in Toronto, reporting into New York, that then reported up into Montreal for National Bank. So it was very interesting. I was marketing across Ontario and east into the Maritimes.
Yeah.
And that's really where you get into this sort of more aggressive style of lending, which you're not in traditional commercial lending. Your box is a little smaller than it is in the asset-based lending world. So it was a great place to learn. A good team. A lot of the folks went on to do some very interesting things. But that was my first sort of walking in the door to do an ABL. And effectively, we were a startup, part of the US group, and it was let's go find opportunities. And the market then was fairly bespoke. We had Congress was there, Bank of America, like all the big boy US guys were here in Toronto. And we were the first Canadian bank, I believe, to actually have physical premises. Bank of Montreal at that point in time was doing all their work through Harris, trying to come into Canada to do deals. So that's when I got into the beginnings of what I think was the real fun part of lending.
So I'd love to dig into your BMO experience first. When you first got into the business, let's go all the way back to the beginning. What was that first year like for you? What were some of the lessons that you learned when you were coming into the banking world? What advice would you pass on to them? And what are some of the mistakes that you made early on in that role?
It's funny you say that. So having left first 100% commission role and then going into a startup technology firm, my only question when I was being interviewed was, what time do the doors open? And so I will never forget, I get there the first day and here's a computer, here's what we're doing. You're going to analyze. And effectively, I was a financial analyst. I'd analyze existing corporate bank customers. So everything from backgrounds, strip the financials, the micro macro market, customer base, publicly traded, a little bit of analysis and that sort of stuff. So I found it quite remarkable that around quarter to all of a sudden, all my colleagues get up and leave. I'm like, where's everybody going? Because you come from a mindset, you work until you're done. It was very interesting to go from working for myself as a commission person and then working for a startup company to then go into this giant bureaucratic regulated business. It was just a different approach. The people were wonderful. We had a lot of fun, and you just start. I think there is still, because it's a long time ago, I can't remember what the corporate borrower was, but I did a market research report on what was going to be the future, either cable, phone lines, or satellite for Canada, based on one of the existing customers. I wish to this day I kept a copy of that, because that would be intriguing to see if I was actually right. But no, when I started with Big Old Bank as a financial analyst, you work hard. It was a good time. And then what happened, at least for me, it was the offer was made, either I can stay in corporate or I could go out on the line side or down into commercial lending. And I always share the story with folks that are coming behind, is that I sat down with my boss at the time, who I'm still in contact with 30 years later, and he still has me on his joke. He's long retired. And he says to me, and I said to him, okay, so Barry, I got corporate or commercial. What do you think? I'm young and a little inexperienced. And he goes, Mark, the difference is that if you have a borrower sitting across the table from a corporate lender versus a commercial lender. And I go, yeah. And he goes, the corporate lender is going to be thinking to his or herself, okay, how much more do I have to drop my interest costs and my fees in order to win this deal? And I'm like, okay. The commercial lender's looking across the table at the borrower and going, okay, number one, how can you make my life really miserable? And how do I protect myself from something really bad happening? And after looking at him, I'm going, well, that sounds like a lot more fun. And he goes, yeah, because he had spent his career on the commercial lending side. So that's what got me over into commercial. I did my training here in Toronto at First Canadian Place. And it was basically working underneath a senior account manager. And basically, I would do all the grunt work, which was fine. But she was a lovely woman that understood credit cold and understood what could get done. I think my biggest lesson is, as I am somewhat opinionated, is that you really have to go make friends with credit. You truly do, because I was that guy that I would fight tooth and nail to get deals done. And it wasn't until later on in my career where actually, and I'll tell you the story, but where you don't have to fight with the people in credit, because once the people in credit respect you for who you are and they realize that you're not going to be sending garbage and that you know what you're doing, they become much more easy to get along with. And I'll never forget, for one of my performance reviews at Bank of Montreal, my regional manager, he's looking at me, he goes, "Mark, you're like a wild stallion," because I was winning sales awards. Because I was having people showing up at 11 o'clock on a Friday night to sign legal docs. I was that guy. I was at this 7 days a week. I was there. And he goes, "Yeah." And I go, "A wild stallion. That's an interesting thing to say." And he goes, "Yeah, because you're there, but you fight with credit. You got to learn to be a little more respectful." I was never disrespectful, but I was very focused on that. And I was aggressive. And then fast forward, like one of my first deals, as I was saying earlier, with National Bank. So I think it was my first deal. So we had a credit committee out of New York, and it was all done over the phone. I get up, present my first deal, for the life of me, I can't remember what it was, and go through the whole thing, addressing the questions. And then one of the committee members goes, "Mark, listen, you're there, we're here, and you've met with management." I said, "Yeah, I've met with them a number of times. Do you trust them?" And I was just like, wow. And I said, "Yes, I do. This is why I'm very supportive of the credit." And they went, "If you like it and you like them, it's approved as presented." That's probably one of the most powerful things that I must admit that I still recall to this day. Yeah, where you'd actually have credit backing you up. And I could go on across a number of places where I've worked where, as opposed to being the crazy person trying to get stuff done, is go massage it through the process. And then there would be leeway.
And so say, for example, you're a younger banker that wants to build a relationship with their credit team. How do you go about doing that in the early days? Obviously, experience is one thing, but is there any advice you could share there or comment on and how you can improve your relationship with credit?
I think it's across the various organizations that I've worked at, the majority of credit folks typically are a little older. They're always approachable. And it's a matter of saying, "Hey, can I come by and have a coffee with you if you happen to be nearby?" And just try to, if you can, familiarize credit with the deal that you're trying to do. I feel for the newbies that are out there and they're in perhaps a commercial branch and God forbid you're by yourself, because you don't get that opportunity to interact with people that have been around a little bit longer. It's interacting both up the food chain and on the line side, and then going and trying to find those opportunities to go talk to credit.
I was just going to ask, and I guess, is there a way, certain questions that, you need to focus on when you're submitting a credit? Like how would you, walk us through the Mark Wilk's approach to underwriting a credit opportunity? What are the questions that you would ask? How would you dig into something and really assess the strength of that company in your eyes?
The fundamentals never really change. And it's how you approach any type of lending. In that, my approach is, number one, is there collateral to backstop what you're trying to do? So your property, plant, and equipment for a term loan, and then your line of credit being secured against receivables and inventory. Can you, number one, understand that? Can you ascertain what the value is, what the collection cycle is? One of the key things that anyone that's looking at doing, even a traditional line of credit, how fast what's the conversion per period of time required in order to take raw materials, convert it into WIP, and then have it turn into a finished goods and get it out the door? Because these are all key things with respect to the cash cycle in the business. So understand the collateral, then look to the cash flow. And then the key thing is what I'd always say to folks when I was doing lending, and this is even to the distressed debt, very aggressive, is management is key, because management runs the business. The business is what generates cash flow or converts their raw materials into finished goods and then sells them and collects. And then the fourth, in all cases, and this is in my advisory business now, this seems to be the number one thing for me. No matter what your business is, be it a distributor, manufacturing, service company, there's always three legs on a stool. One is sales, two is production, and the third is financial internal controls. And so when you're doing your underwriting, you're looking at businesses, that component is equally as important, because as I explain, especially to companies which come to me that are a little broken, is I go, the minute you've lost your internal controls and you've lost control over what's coming in and out of your business from the money standpoint, you've lost control of your business. So that aspect is equally very important. If you're formulaic in your lending, if you're doing traditional commercial lending, you can go up to total debt to equity. I don't even know these days. It's as high as 3. If you get any cash flow, the multiples are a little bit different. Is there the appropriate level of working capital to support the business? Is there collateral? Does management know what they're doing? What's the plan going forward? How they perform versus prior plan? And then look to the fundamentals. And this comes from experience. The more you deal with companies, the better you are at seeing trends within organizations. And so for me, those were the fundamental things that I would look to when I would be underwriting a transaction.
And Mark, that's fantastic. I haven't heard the 3 legs to the stool comment, but that's a great way to think about assessing the credit quality and just the overall quality of a business. I really appreciate that. So that's a great analogy to reference for younger bankers. So I'm curious. So BMO, you went then to National, and then you progressed down towards the ABL sector, and that's where you spent a large chunk of your career. So maybe just for listeners that aren't in the ABL sector today, how would you define ABL? Like, what would be the type of product, the term, the cost, the amortization? Just give us a little 101 of what is ABL for bankers that may not know that.
To me, the term asset-based lending is a misnomer, because if you're doing equipment loans, you're lending against assets. In what the banks have classified as this lending group, effectively what you're doing is more highly leveraged working capital finance. So you're doing primarily lines of credit or operators or revolvers, depending on Canada, US, but you're doing lines of credit secured against accounts receivable and inventory. Some of the groups have expanded and will pick up some of the term assets. So if there's some equipment to be financed, but everyone has different rules. But by definition, asset-based lending is, I'm going to call it more aggressive working capital lending. And how does someone go about doing asset-based lending? Effectively, the real difference is if you look at if I go back to my time at Bank of Montreal doing a line of credit for someone, that someone would be reporting their aged accounts receivable, aged accounts payable. Their listings would come to me 20 to 25 days after the prior month. And in traditional commercial lending, your advance rates are very much more conservative because of the time lag with respect to your reporting. Because, you've provided a $10 million line of credit against receivables, and then you have 30 days of which you're lending them against your receivables, not taking into account what is being collected and what your actual underlying value of those receivables are. The difference between that in commercial lending and doing asset-based lending is much more higher frequency of reporting. I have had clients that would report to me on a weekly basis. If you look at the inventory, asset-based lending typically where in a regular commercial deal, the company has its bank accounts. The bank puts money in, takes money out. They don't have what's called blocked accounts. Asset-based lending, especially the Americans that come into Canada and the more aggressive deals, what you do is you take a control of the company's account, in that you can then monitor all the cash in and the cash out from the company's account. By monitoring the day-to-day cash once more, it's more frequent from a reporting standpoint. If all of a sudden there aren't being deposits, that ding, 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 the alarm bells go off. So that effectively is how, from a reporting standpoint, as well as what you're trying to accomplish, because you have the additional reporting, what it also does is it frees up the kind of the covenant structure that you can put into deals. So you have a higher tolerance for leverage. Effectively, you look at it like this. From a commercial bank deal, 75% against accounts receivable, reporting 25 days after the prior month. 50% against inventory, capped at some notional amount where you're probably getting between 15 and 20%. Okay, that's your commercial banking type deal. Asset-based lender, you're getting 90% against accounts receivable. If it's investment grade, you're getting 65, 70% on inventory, because obviously you've done an inventory appraisal. You understand the conversion cycle. And your tolerance for leverage would be greater, where in a regular commercial deal, you can't go more than 3-to-1, 5, 6. Sometimes you don't even have a debt to equity covenant. You're probably more focused on cash flow, so total debt to EBITDA. Because once again, if you had 2 identical borrowers, one's a commercial borrower, one's an asset-based lending borrower, and on day 15 after the prior month, both went into bankruptcy protection, the asset-based lender will collect more because they have more knowledge of exactly what's there, what the conversion cycle is, and they have more options versus 15 days in for the commercial lender, which has low advance rates that gives them a larger buffer for that whoops factor that can come into place.
That's a fabulous overview of the ABL mindset of how to underwrite credit, and the difference between traditional commercial banking and ABL banking differs in terms of how you look at opportunities. So I appreciate that summary.
Then you get into where does ABL fit into the world? And for me, if you look at high growth, it's like a bell curve, high growth and financially distressed. The commercial bank is in the middle, right? The ABLs can stretch towards, because of the more higher frequency of reporting, as well as the better knowledge of the underlying collateral, they can stretch more towards and deal with more broken companies. And the same side on the good side is they can go into perhaps more aggressively growing companies that don't fit within that. Once again, if you have these typical commercial banking ratios, 3-to-1 total debt to equity, maybe a debt to TW, I want minimum working capital of what to what, et cetera, is that because you have this higher frequency of reporting, your complexity or your risk tolerance actually improves versus erodes because you have the higher frequency of reporting. If you understand and know your collateral, theoretically, unless it's a fraud, with an asset-based lender, if a company does hit the wall for some reason, theoretically, if you're up to date and you're following the right rules, your losses might be a little bit on the fees and a little bit of interest, but you should theoretically be getting back all of your principal that you have deployed into these situations. If your underlying monitoring and your original credit thesis was correct and you were following up with and the company was following up with its reporting.
So that's a perfect segue into really the discussion around when a file does go sour. It's an underperforming loan. Something's happened in the business. That's something that for most younger bankers and junior bankers, they're a little bit nervous. It's the first time they may be going through something like that. And when you're dealing with a troubled case, what advice do you have for younger bankers in terms of what to do in the early days? What's the process that you follow? Talk us through that journey so that bankers that are listening to this at least have a sight line into what the next steps would look like.
Sure. And that comes from the advantage that the new banker has is high likelihood that they're doing cradle to grave. And when I cradle to grave, they source the transaction, they underwrite the transaction, they paper it with lawyers, and then they monitor and then report internally every year into credit or whatever the adjustments are made. That one of the key things, and the unfortunate part is that when lenders are young and new in their career, they tend to get, here's a portfolio and they dump it on your desk. You got 50 accounts or whatever the case may be. And you've got to try to get up to speed. And then because you're doing all aspects of the credit monitoring process, plus trying to find new deals because everyone has new targets to make your portfolio bigger, is that you got to stay on top. And hopefully, if this is doubtful, you're going to have a wide, diverse number of clients in a big bunch of different areas. My key recommendation is, and I know it sounds like it's elevator analysis, but try when you sit down and let's say you have a banquet hall on your portfolio and you got a bunch of money into it, take a look and then go back to the last time you did the review, look to the numbers. If the company provided projections, pull that out of the credit file, take a look and see how are they trending towards what their plan was. If you as a new lender go, wait a minute, and I can tell you the story of a deal where it's just really quick. I had financed this technology distributor in Ottawa many years ago. And so one day, and I was cradle to grave, so I was doing everything and I'm reviewing the aged accounts receivable and aged AP, verifying their borrowing base. And I look and I go, what the hell is this? All of a sudden on their receivable listing was one of their suppliers. And I'm going, what's going on? So I call the CFO and I go, dude, we returned some equipment. And I'm going, huh? I've never seen this before. They've been with me, 6, 9, 12 months. So I'm thinking, this is odd. So I'm going to come for a visit. And I got to tell you, this was the scariest moment. And I think, so the company, it was a small borrower, like $10 million. And the inventory was at the highest it had ever been as this growth pattern and receive was primarily inventory. I drive up there. I walk in the back warehouse and I almost threw up there was basically nothing in the warehouse. They were lying. They were overstating their inventory. Oh my Lord. Oh, it was crazy. So you know what? The fundamental thing with just how do you determine if somebody's starting to go sideways? As the account manager and as you're monitoring this, you got to try as best you can. And I know it's hard because you get overwhelmed with the requirements, especially as new lenders in this day and age. Try to go back, look at your past and try to make some notes and maybe just create a little Word file and company X, it does this. And what were your observations? Go back, look at what you've done before. See when things start to go a little bit sideways. Is cash off? Look at if it's a manufacturing company. If all of a sudden receivables are getting bigger and inventory is going up at the same time, why is that? Like, why would your inventory be going up and yet your receivables are going up, but the cash is, what's the conversion cycle? What is it that's triggering that? So then when you identify that there might be a problem, first thing you do is get on the blower, call credit. Because the credit person that you deal with will be somewhat familiar with the file, but has a much broader exposure across their portfolio that they're providing assistance with. And then the next call that you make is to your leader of your team or of your group and say, hey, something's going on here. And then what you do is you ask your team leader or director, managing director, whatever the case may be, to go and set up a meeting with client. And then arm yourself with the data, get on the phone with the company. Hey, something's a little bit odd here. What's going on? Fill me in and I want to come for a visit. And then go have a sit down with management. It's a tough answer to your question of what do you look for? I know what to look for, but then again, I love distressed debt. So to me, I could smell it from a mile away. But when you're young and you're new in your role, it's the small things that will trip people up. You have to always understand that the road to hell is paved with good intentions. And a lot of cases of the deals that I've seen across my career, it's management tries to pull a little fast one on the bank because they need a little bit of liquidity. They start getting along and they start getting into arrears with CRA. That's a big no. Always ask that question. Where are you with your priorities with respect to Canadian revenue agency? So that's another one because that can come and bite you so hard because of the fact that it can be a priority if you do go into liquidation. So go talk to the people. Something makes your tummy go, something's weird here. Then go grab more information and then go talk to people internally and then get in front of clients and just go, hey, what's going on? And then hopefully someone a little bit older, perhaps with a little bit more experience, might see quickly through to it and see what the fundamental problems are. If it's really messed up, then it gets slid over to the special asset group or the workout group. The best thing you could ever do is put your hand up and say, hey, they got a red flag here. Something's bugging me, even if you don't even know what it is. Because the folks that have been around longer may see through it a lot faster and may have had experience in that particular industry sector. I remember I had a broken file when I was a junior lender with Bank of, and that's what I did. I talked to credit, said, okay, how are we going to deal with this? And then they were like, okay, so they would shadow the file and monitor, and then I would do little memos to them. And we would go back and forth with respect to trying to clean it up and either transition it back in so it was a good deal again, or, hey guys, like we got to go next steps and get the heck out of Dodge.
Yeah, that's a great answer. And it's a good summary of just the thinking, which is report as much as you can, deeply understand the problem, get to the source of the information, get in front of the client physically. Don't just do it on the phone, but go out and actually see the place and assess the situation in person. And the earlier that you can do it, the more time you have on the clock to maybe get ahead of a problem. Sometimes it just get away from you, but other times maybe you can get ahead of it. So say, for example, in certain banks, the file actually stays on your desk, especially if you're in the ABL group where you actually have to work out the file. And I've heard from people that we know, mutual connections, who complain a lot about sometimes the younger bankers that are in these workout situations don't really know how to facilitate communication between all the parties in the room. So what advice do you have for just managing the tension and the stress and the different priorities of the lender, the management team, possibly the investors? What practical advice do you have for bankers to just manage that whole process? Because that can be quite overwhelming and stressful.
Yeah. And I come at this from different perspectives because I've been in both big organizations and in little tiny organizations. You're right. You do everything. And it's your responsibility because especially if you underwrote and the deal goes sideways, it's all your fault. If you're working for one of the banks and one of your deals starts to go a little sideways, document. That you got to, this is what I've seen, this is what I've done, and I've documented this, and then go down that path. Companies experience pain. And one of the key things, and we can get into this, is because I know we were going to talk about when you get really down into the distressed debt stuff that I was doing, like that was, it's a same basic functionality, but your approach is vastly different. But in the case where you're working in a big organization, it's number one, harness the resources around you, even though you have to manage it. It's dialogue with your director, your managing director, dialogue with credit. Here's my plan. This is how I'm going to approach this. Dialogue with company, everything. Keep records of every single correspondence you have with them, depending on if you are doing everything. If let's say it's a line of credit and you've got receivables and inventory. So obviously you're now going to start monitoring the cash account if they have a blocked account or lockbox, however you want to call it, where basically all the cash goes in and out of one account. You're going to start monitoring that. You're going to also look to their accounts receivable listing. Are they actually depositing all their money? Key thing in the asset-based lending world is that if at the beginning of the month you have 5 million of accounts receivable, and at the end of the month you have 4,500,000, you should have cash collections of X plus new sales of Y, and that should add up to 500,000, which is why it went from 5 million to 4.5, if you understand what I'm saying. So look to make sure that there's no cash diversion, because now what it is you're going to full-on defensive mode. So you have to protect yourself. Monitor, follow the cash, talk to people internally, look to third party. If let's say you're lending against inventory, go get a new revised inventory appraisal, because depending on what their inventory, if they have a perpetual system, whether or not they're doing monthly, quarterly, annually inventory test counts, where is the inventory? Because now what you want to do is you want to make sure that you're following the cash, what goes in and out of that business. And then hopefully you can go have a conversation with the owner / management team and go, guys, what happened? And you hope what they're going to say to you is, well, gosh, hey, Mr. Lender guy, person, we lost one of our big customers. Oh, okay. So that's why sales have fallen, receivables have dropped. What are you doing? What we've done is that we've rationalized, and this is where I'm now getting further down the path when you do distress lending. But in this particular case, like, what are the steps that management's taking to fix the business? Owner says, we lost a little bit of money. I've ponied up, or management team has ponied up some money in equity to support the business. We understand that why you'd be concerned. Here are the steps. Here's our plan for the next period of time, both from a short-term, mid-term, long-term. So let's say we lost a big customer. We're now marketing. We've rationalized our inventory base. We may have cut back on our production if it's a manufacturing company, because we don't need to manufacture as much. So therefore, we're going to cut back on our costing. And then the immediate thing you want to do is, and this is more for typically larger corporations, but what the special asset guys would ask for is you go, okay, I want to get a 13-week cash flow out of you. And this is going to be rolling every week. And so basically any CFO or management team has visibility. 13 weeks, you understand what your employee costs are, your rent, your hydro, heat, lights, et cetera, et cetera. And then what monies do you expect to come in, depending on the seasonality and the nature of their underlying business. Where's revenue come in? What's it going to look like? Where's the gap? Because now what you want to do is establish where can you potentially help the company. Because if you see an impending cliff where, let's say it's a seasonal business, and it's a lawnmower cutting business. The peak of the sales is going to be in the spring into the summer. In the mid-dead of winter, nobody's selling lawnmowers. But if all of a sudden there's a cash crunch, well, you as lender have to then make up your mind. How can you assist the company to get them through those type of events? Complete openness, hopefully high levels of communication with the owner and the management team to have them convey to you what their issues are. That is what leads to the development of really good and long, sticky relationships. The fact that a junior lender would be taking that approach shows discipline and maturity, that they're going in there and asking these questions. And as a junior lender, if you don't know what to do, take someone that has been around for a while. Take your boss with you and go through this process with somebody else in the room. Actually, as a junior lender, if it's one of your first files, I highly recommend don't go by yourself, because you're not going to be able to write notes keep track of what's going on, because obviously you're under stress as the lender, because it's your feeder to the fire as well for trying to find the solution. As I said, I think the key thing is that when you identify trouble, try to identify it as early as possible. The difficulty is that how many hours are there in a day? And I truly think that some of the folks, as much as some of the banks and other institutions, they're relying more and more on technology to hopefully find cracks. But it's really boils down to someone that can eyeball a balance sheet, income statement, and go, something's weird here, something's bugging me, and then be able to then take action and just either quell the fear or quell the potential issue, or dig into it so you understand better what's going on. Because the other key thing you have to understand is that businesses are fluid. Businesses change, and sometimes there'll be a transition in the business. And it's very difficult if you're only talking to the client when they need something or for their annual review, then you're not as in touch with what's going on. Now, the ABL world, because of the higher frequency of reporting, and typically it's not just one person. You'll have some analysts which are grinding through and validating the borrowing basis. And then so you're either a finder, minder, or grinder. If you're either portfolio or on the monitoring side or analyst side, then you're going to hopefully see that because you're closer to the trends, where your finder who's out there doing the selling perhaps will have a high level view, but won't have the detail.
Yeah. And that's a really good overview as well of just going into the next chapter of the conversation, which is you are a finder. You're a rainmaker, a deal maker, someone that brings in business, that's well connected on the street. So for someone that wants to be like you and to attract business and develop it, what advice do you have around sales and developing relationships and leading these conversations, especially when you're younger and maybe you don't have the white hair that you can walk into a room and have that instant credibility, but you have to earn it because you're younger and you're hustling out there. So talk to us about that and what advice you have for younger bankers there.
Yeah, I really think is that, and as a young banker, and I remember when I was a young banker, I'd go into some of these association meetings and I'd be looking around and I'd get to your point, and there'd be gray-haired guys. Oh, I know that guy. He's a senior dude over at, could be even within the same organization that I'd work at, or one of the subordinated debt guys or mezz guys or private equity guys. And of course, you just, I'm doing less than 5 million loans or whatever the case may be. These people would never, like, what value do I provide? And my answer to that now that I'm older is that people are people. Go put yourself out there. Go introduce yourself to people. Go say hi. One of the key things I tell folks, because I try to help those that are fresh out of university trying to break into the job market. And it's very difficult right now. And I say the same things to folks that get in there because I've mentored a number of folks as they've been going through across their careers. One of the key things is, number one, if I had to do it all over again, number one, focus on the folks that in your graduating class. Where do they go? Keep up with them. Number two, go make relationships. Go to where the deals come from. So if you're at one of the banks or one of the ABL banks or one of the non-bank ABLs, is go talk to the corporate finance. Get invited and go meet. And if they're your classmates, which is stellar, and they're now a junior accountant, go talk to those people and talk to the ones that are about your age. I find it remarkable that I can sit here today and I know pretty much on a first name basis every one of the heads of the national insolvents of the accounting firms. As you grow throughout your career, your colleagues, classmates, and others will also be rising within their respective professions. Keep up with people. Network as best you can. If you got to put it out of your own pocket, fine. Go to the Association for Corporate Growth. If you're ABL, go to the Turnaround Management Association. Get the firm to support you so that you can go to these events, hobnob, meet, talk, and develop relationships with people. What you'll find is as you go throughout your career, people look at, I've been complimented. Mark, you look at a transaction and you make it look so easy. I go, yeah, because I spent 30 years honing my skills to make it look easy because there's a lot of stuff like the little duck that's sitting there on the river. The little feet are going like crazy. The duck itself is just sitting there in one place. So key relationships and humbleness is the other key thing. Be nice to the people in your organization. Be nice to the folks that teach you. If you're working in a bank, cash management, everything. Be nice to everybody. Even as you're being promoted through the ranks, be nice to those folks. Relationships are key, internally, externally. Be a nice person. Be accommodating. One of the other things that I think has really benefited me across my career is that, look, you have to understand in the world of finance and banking that, especially if you're going to be a lender, no is just as good as a fast yes. None of this dithering. There's nothing worse than you don't know what to do. If you can't do the deal, find out quickly, tell the borrower. They would rather hear from you that you cannot help them so they can go find alternative means. Next thing you know is because, the good Lord gave you 2 ears and 1 mouth, you should always listen twice as much as you speak. When you go to these events, go talk to the people that do really interesting things. If there's a sub-debt guy or person at an event, go up and introduce yourself. Hey, my name is Mark. I work at whatever bank. I'm new to the industry. Could you tell me what you guys do in your shop in case something comes across my desk that I might be able to send your way? And then you are going to have a person that's going to say, oh, this nice young person came up to me and asked me a question. And if you're polite and you're pleasant and you acknowledge what they're saying, they will tell you their life story. And what you do is you make a note. And one of the only things that I really regret, and LinkedIn's kind of fixed it for me, is that I always, just because of the number of people that I know and I have met over the years, is I really wish I'd created a database in Excel to say, okay, I need $38 million. It's in US dollars. It's against floor plan financing in the auto industry in Kentucky, Ohio, or Kentucky. And then be able to go and say geographic, blah, 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 and do a sort and find that sort of thing. So go be that person. Be the person that when folks call you up and you have to say no, but you say, look, I can't help you, but I'd really recommend you call this person, or these are the people that I know. And tell you what, I'll facilitate an introduction by doing that. You do not know how powerful that is. So number one, the recipient knows that if it's Junior Mark has just referred over this company looking for potentially sub-debt, they're going to say, that Mark guy, what a good egg. And you know what, maybe the next time I have a senior bank deal, we can try to slide it his way and he can come and help us. And this is the way you develop a Rolodex. And then depending on your role, geographically speaking, like when I started off my career, I was just a Toronto guy, and then expanded into Toronto, Quebec, and the Maritimes. And then fast forward, then I was right across Canada and the US. And my little Rolodex got ginormous, and you keep up with people, and people always appreciate. And once again, how to get into advisory is that when I call people and people call me up and they go, hey, look, I need some help. And I go, okay. And I listen to their story and I say, this isn't me. Like, you don't need to hire me to go find you money. I want you to call my buddy, Jim. Here's Jim's phone number. When you speak to the gatekeeper receptionist, just say, look, Mark told me to call. I'm supposed to talk to Jim, and then poof, right in front of Jim, Jim's going to call Mark up and say, hey, Mark, I appreciate the referral. You send the deal to those people, and that becomes appreciated both by other folks in your industry, referral sources that call you up. One of the biggest things, and where I'm quite successful, is I get other financial intermediaries call me for help because they don't know what to do, because it's either a restructuring deal or it's something that they can't, after they go through the 5 big banks, what do you do next, right? So then they can call me up. If I got to roll up my sleeves and help you put together models and do stuff, then I'm going to take a chunk of the fee. Or I can just say, call this person, same thing. Be that person that has the connections, is there to help. You listen to the story, and even if it's not even close to your bailiwick, listen attentively, and then ask the appropriate questions, and then say, hey, look, I can't help you. There's nothing worse than leading, like, one of your clients. Let's say they decide they want to do an acquisition, for example, their existing borrower, and you don't know what to do with it. So it gets pushed to the bottom of your pile. 2 weeks, 3 weeks go by. Your customer is trying to do something. You have to be able to deal with this, and being upfront and honest. Look, I haven't done this before. I need to talk internally to people to find out what is the best avenue to find out how it is we can help you. And that can be, if you're a traditional commercial banker, it's maybe you're going to go meet people in the asset-based lending side. Maybe it has to transition from your desk and transition to a more aggressive lending strategy, which would be an ABL. Maybe if you're at BMO or CIBC, or all of them have cash flow lending groups or leverage finance groups, maybe this is an acquisition scenario and they're going to need some subordinated cash flow, like cash flows type deal, so that you're keeping it within the organization, but you're being timely with trying to deal with it. There's nothing worse than someone who doesn't know what to do, freezes, and then 3, 4, 5 weeks go by, companies angry as all get out, and then there's a very high likelihood that you're going to lose the entire relationship.
Yeah, no, that's well said. And we haven't really even touched on one of the biggest stints of your career, which was at Calidus. You spent over 12 years there, did a lot of transactions. So maybe just steering the conversation towards that. A, what was that experience like going from more of an ABL group within the bank to more of a private institution? And B, what were the big learning hurdles or the learning gaps for you going from probably the bank to something that's more of a private organization or publicly funded organization? Because there's a lot of bankers at these banks today that dream about working in private credit. Obviously, how do you get to private credit and how do you succeed in private credit? So what are your thoughts there?
Yeah, one of the key things is that, so once again, because I've had such a weird sort of career, I'm going to say this to you, because especially the young ones that are listening to our conversation, it really boils down to your personality. And I'm going to be the first one to say, I'm pretty confident that I'm going to be successful at whatever I do. And I'm a leaper in that I'm looking across the chasm and I jump to the other side. And when I land on the other side in a new role, new job, new area, I go figure it out quite quickly. When it gets into private debt, and I really think there's something that, we haven't really talked about, but because I went to work for Roynet after I left National and before I joined Calidus. I go into Roynet, and Roynet's a subsidiary of Scotiabank, and I was there in the early days when it's now become very integrated with respect to Bank of Nova Scotia. But back then, you could do deals with others. You could do term loans, cash flow loans, and mezz, and then they only did 3 or 4. They did full-on majority equity deals. So of the 4 majority equity deals, which we both looked at being roll-ups, I sourced and sat on the board of one, and then I sat on the board of another. So completely different mindset. So within this giant bank, managing a couple billion, but not the hugest team, and had that opportunity. And that's that experience of having to stop looking out your belly button at what's gone on before, which is typically what bankers do. The future is the future. You don't rely on the future because otherwise you think you're doing equity. But it's being able to look what's gone on in the past, see what happened, see where the company is today, and then look to the future and say, and then be able to analyze the strength of management with respect to their ability to execute upon that plan. Perfect transition into Calidus. Calidus, I joined them in 2008. As we all remember, the wheels were coming off the wagon. The economy was going into the crapper. Things were tight, leverage was high, banks weren't very happy, and I go walking in there, hey, how you doing? How are we going to do this? What was Calidus? Calidus, it's effectively an asset-based lender, but we didn't have all the rules. And we had a regular ABL group, as I distinguish between a commercial bank and an ABL group. We were an ABL group on steroids. We could go into I never did figure out what the maximum hold size. I think the biggest deal that I did that we held was $350 million. And we got paid like bandits. It was wonderful.
Wow.
But private debt, what is private debt? Private debt is going in, looking to the underlying collateral. So effectively, you're doing lines of credit and term loans. You're looking at what's gone on before. You're looking at where the company is today. And this is the toughest part about this. And this comes from experience. I could walk into a broken company, receivers a week or two out, and I could walk the floor in any kind of industry and within 15 minutes tell you whether or not we could do the deal. And not knowing the deep particulars of the underlying minutiae of the margin formula, but I could walk through. I'd look at the CFO. I'd look at the employees. I'd look at the owner. We'd walk the floor. I'd see how the employees react. And if I had this kind of weird, I call it my spidey sense, and my tummy's going, something here's bugging me, I'd walk away. Because the fundamental problem is that we would do deals fast. Like our meeting to funding was 12 days was our record. And that was a company where the receiver was going to come in the next week. So we had to close it. wide range of everything from ship scrappers to automotive plants to lumber manufacturers. Like, I looked at everything and I did everything. Back in '08, as automotive parts companies started to suffer, the analogy that I'd always draw is that when the banks are running out of the barn that's on fire, we'd be running in and we would go in. I'd look at automotive parts, where before there were 6 companies that made side view mirrors that go on the cars. And let's say of the 6, 3 of them were living on the delta between the Canadian US exchange. Market goes sideways, sales drop, they're disappearing. My underlying thesis was, if I'm financing one of the 3 guys left that can make side view mirrors on, that they're pretty ones that go on the outside of a car, I don't care whether they make 10 million, 20 million, or 100 million cars, because as long as the balance sheet's solid, there's going to be a demand for their products. So you got to be able to pick the winners. And winners to me in private debt are management team, the guys that I would go in, especially, and this is now I'm touching on the distress side, but distress is also high growth. It's truly, you've got management that's right, stressed, not de-stressed, but either because they're growing too rapidly or something's gone on or something's gone sideways on them. The ones, Rob, that I could help is I'd walk in the door, hey, I'm Mark, and they'd look at me and they go, Mark, oh my goodness, we lost GM as a client if it's an auto parts company, or we lost this other customer, or we screwed this up. And I'd be like, okay, guys, so what did you do? Mark, we've rationalized our workforce. We've cut back this. We've done this. We put money in. These are all the steps that we've done. But our incumbent lender, it's not enough. They want more and more. And we just don't have any more to give. Those are the guys that I would stand up and say, I will help you. Versus the other knuckleheads I go in and see, and maybe it's a small public or whatever the case may be, and I'd be sitting across from owners, and they're like, so Mark, listen, last 2 quarters have been really bad. Yeah, you guys are losing money like crazy, and you're technically almost insolvent, so you're going to run out of money, and your bank's pissed off. Because obviously, look, I've done pretty much everything on the balance sheet, so I know whether or not their bank's going to keep them or kick them out. And I'd look at them and I go, okay, and what have you done? Mark, it's going to be all better on the 4th quarter. And what if it isn't? Mark, you're way too expensive for us and we could never take your... I'm like, okay. And I get up and walk. There was actually a company. I go in and I sit down with this, and it was in the film industry here in Toronto. It was a public. And they'd hire some senior guy out of Sony or one of the big movie houses. And this individual was so full of himself. And he's sitting there and I'm looking at him and I'm going, like, I know your bank's kicking you out. So you're public. I'm looking at your filings. And he goes, well, Mark, I know a lot of people. And I'm like, I can't remember his name. I go, Bill, Bob, Tom, Frank, whatever his name is. Listen, you say some senior people. I got some friends. What I want you to do is tell me where you don't know someone, because I know no one's going to touch this deal. I will give you VP, SVP, every single person at any of the institutions where you don't have connection. I said, yeah, because I want you to go out and understand the market that you're in. You are not big shooter from the US coming into Canada and you're going to tell people what to do, because you're basically do you know that knucklehead, they bankrupted the company because he couldn't get past his own pride to come to somebody. They tried to do an equity. It was so, they tried to do a bought deal. It was, but anyway, I'm just going, so private debt. What are the key things with private debt? Ability, number one, as it's basically banker 101, but on steroids. So you're fundamentally doing the same thing. You're looking at what's my underlying collateral. You're very focused on the cash in and out. You're very focused on what the contracts are, how much money, and what the financial controls are in the business. If you don't have strong financial controls, run away. I would rather do 1,000 deals with a busted company and strong management than do one deal with weak management and a relatively strong company. Because the one that has the weak management is going to blow up. I could tell you stories. The number of, especially poorly run companies, I go in to meet them and I'd be looking at their financial statements. I'd be like, guys, this isn't a refinance. You're technically insolvent. You want me to give you some names of people? Because you're going to have to go into protection, maybe do a Phoenix flush through CCAA or whatever the case may be. They would be sitting there looking at me like deer caught in the headlights. And this to me was the kiss of death. Mark, we're thinking of buying this other company that's bigger than we are. And then I'd say, oh, that's wonderful. Thank you very much. And get up and walk out. If you can't run your little company, how do you expect to take your lack of expertise and you're going to go buy something bigger? Do you hear yourself speaking?
an awesome overview of just, again, going back to the basics, which is often like lending is really a person-to-person business. Yes, there's big banks and there's big dollars behind it, but it's you, the banker, making an assessment of the people that are running that business. And majority of your credit underwriting centers around your knowledge and experience of assessing the strength of that management team. Oftentimes, if you have a really good management team in a shitty sector, they're still going to do better than a really poor management team in a good sector, because management team really drives the ship and influences the outcome of that business. So again, all these stories really confirm the same message, which is from a core underwriting point of view, what to focus in on. I'm curious, just a little bit more about the more bringing it to the banker themselves. When you look at private debt and ABL, what are the 3 to 5 skills that you would say are required to be successful in this sector from a banker's point of view? What do you need? What does it take to really succeed long-term in the space?
Long-term, I just can't reinforce this enough. People skills. Can you interact with people? Can you go out, meet new prospect? And once again, you have to go back into what role. And my thing, and Rob, you'd appreciate this, when I meet young folks and they come up, hey, Mark, I want to get into banking. And I go, okay, so what do you want to be? Are you a finder? Are you an originator? Are you a minder? Are you a portfolio? Or are you the analytic to deal with the day-to-day reporting and everything else? And the way I always characterize this is if you walk into a cocktail party, for example, where you don't know anybody, if you're the person by the end of the cocktail party that you've talked to 65% and you're handing out business cards and you're having yourself a great time and you're on your 4th tequila, odds are you're probably going to be an originator. If you're the type of person that walks in and you establish 5 or 6, but really good over the course of the evening, good relationships and build up, you're probably a portfolio. And if you come and you meet 2 people and you stand in the corner, maybe you're an analyst, right? So you have to figure out what it is that you're really good at. And so when I say people skills, no matter what aspect of that world that you're potentially going to look at or be in, can you interact with other people? And that's both internally and externally. That to me, I think, is your number 1. Number 2 is obvious, which would probably be financial analysis. You have to have some semblance of understanding of what a balance sheet is and a cash flow statement and an income statement. And how does that work within what you're trying to do, be it you're finding deals, underwriting deals, or your portfolio, right? So you have to have that financial analysis. Collateral. The most important thing is you lend against collateral. Have to understand it. You got to get third-party validation. If you don't understand it, or how do you control it? And then what you need to have is you got to have market knowledge. And market knowledge comes from experience, but it also comes from reading the report on business every day or Google News or whatever. What is going on? What are the macro trends that are happening in Canada? And then on the micro side, if you can learn something. When I was financing auto companies, I could walk into a stamper conference and I could go talk about used stampers, and I knew it was $1,000 per ton. And I'll never forget meeting a guy. Hey, how you doing? What do you do? Oh, I lend money against stuff. Oh, I'm looking at buying this thing. Oh, is it like $6,500,000? The guy looks at me. How'd you know that? He's like, all of a sudden I'm his best friend, because I could tell him something because I knew something about that particular industry that I happen to be playing in. So to me, nothing is more important to me than people skills. And then, of course, the other thing is fire in your belly. And look, as much as we have spoken about ABL, commercial lending, talked a little bit about sub-debt, we talked about private debt, all of these things are attainable, especially for someone that's young and coming up. If you've got fire in your belly and you're nice to other people and you go out there and you market the fact that you're nice to other people and you try to be helpful, you can learn. Because people like to hire other people that are like themselves, right? I like people that are like me. So how do you get into these roles? It's not like you got to be crazy aggressive, but if you're confident, you can get into these interesting areas. Focus on what you're doing, be the best that you possibly can, and be the best both, as I said, internally and externally. And I think those are the biggest skill sets. Ask, learn, Try to help out where you can. Like when I coach some of the folks that I've assisted getting jobs at the various banks, and my running joke is whichever bank color, TD is green. When you join TD, you're wearing green underpants. Is that go be proactive, be the first one in, be the last one out. Go find out what charities they're involved with. These are all things to make you be noticed. I can tell you for a fact that I had lunch. One of my colleagues, when I started at Bank of Montreal, that came behind me, is now head of the commercial bank for one of the banks. And him and I were having lunch, and it was a Friday, and there may have been a beer or two consumed. And I said, so when you get back to the office, what's going on with these employees being in the office, not being in the office? And he goes, well, the interesting thing is I'll go back. Like he heads up the commercial bank.
Yeah.
And he goes, I'll see a couple of the youngins there, and I know their names because I know who they are because they're there on a Friday at 3:00 in the afternoon. So we haven't even touched on that for bankers. Go in the office, be seen by the people, because the only way, number one, culture, number two, culture, number three, education and learning. You learn so much by standing by the coffee machine, having a coffee with one of your colleagues that perhaps has grayer hair than you.
That's right.
And say, these are the things that are very important. So
fantastic. That is awesome advice, Mark. That is exactly, I can't stress it enough. One of the things that for me, I was able to learn more simply by just sitting outside the office of managing director or partner, listening to them handle a client situation on the phone, and then using that language when I was in a meeting in a similar situation. This is an apprenticeship style business where you have to sit around people that are senior to you, that are experienced enough, and learning from them. Right. And the only way you're going to do that is not virtually, it's not working from home, but it's being in the office. I'm dying to know, you've done a lot of deals. Which one are you most proud of? What's the most exciting one that if you were to look at and say, that's the deal, that's one of the coolest, most interesting things I've done? Tell me about the most interesting or coolest sector that you've lent to. And what's that story like?
It's an interesting question because I was reflecting on that, about what it is that I thought was the coolest thing. I have financed the building. I've done 2 deals that had military things. I financed 6 two-seater fighter bombers for Department of Defense contract years ago for a couple of ex-Air Canada pilots. I helped build the supply ship, which was, I think we were $350 million. We helped them build this thing. And then it went on. It's now supplying our Navy, because at one point in time, our Navy couldn't go more than 200 miles offshore. Otherwise, we'd run out of gas. And so one of the things that's really interesting, and we touched on it, and what private debt can be, there's focuses. You can be a high growth person or you can be a distressed debt. I seem to spend much more of my time in the distressed debt. Rob, the number of jobs that I have indirectly saved across my career is astonishing. If I sat down, there was a plant in Northern Ontario, which 65% of the entire revenue of that town was directly and indirectly related to this plant. And so we went in there, and it was a pulp mill, Northern Ontario. And so we went in there and refinanced. The Ontario government came in, kicked in a bunch of money. We threw in a bunch of money. We got this thing up and going. 4,000 employees. Like indirectly, we saved a town.
Wow.
And I'm the first look. We're not philanthropists. We charge for what we would do. We were expensive money, but we could save so many businesses. And then the cool thing is, because you were in the biz as well, and especially as junior lenders, I will never forget going into a foam manufacturing plant with 300,000 square feet under roof. They were extruding foam in 50-foot thing. It is the coolest thing ever. You go walk through an automotive plant and you see what these guys, like, to me, one of the most favorite, just as a quick story, and I'm sorry, I babble too much. They cleaned off the overburden in the oil sands. So basically what they did is they dig up all the stuff, and they had these Titan dump trucks. In order to get to the bitumen to be for the oil sands, you got to take off the dirt and the rocks and the trees. So these guys, what they did is they had these giant, size of a small apartment building, Titan dump trucks, and they'd load these things up and go dump the dirt. And after you mined it, you hit the bottom of the bitumen, they come back and fill up the hole. So this guy comes in with his wife, and he was from Newfoundland, and he's sitting across from me. And troubles as trouble can be, because there's the two big ones. There's Syncrude and what's the other one? So he was at one place, they had a fire, so he packed up all his equipment, drove across the highway to the other side, and there had a problem. So anyway, he was caught out. He was just way over levered, and he comes in, and so my running joke to the guy is, hey, listen, if we finance, and I think he was looking for $100 million, and I go, can I come out and drive one of those things? And he said, and he's a good old boy from Newfoundland, right? With the total accent. Mark, you come out, I'll sit beside you, we'll teach you. So anyway, my long-winded answer is that, with respect, I have helped some really cool management teams do some really interesting things. We have saved across my career, and I've had the absolute pleasure of working with some of the smartest people in Canada and the US. And that's both from referral sources to internal colleagues and the folks that I work for, the CEOs and the folks that were senior to me. There is no one deal, but we could sit here for the next 3 hours and I could tell you stories about stuff that I've seen, and you're going to say, oh, wow. Like it was just fun.
The beauty of this business is that you get to meet some really interesting people, because entrepreneurs, they're really free birds in that way. They have the ability to do what they want to do. And there's a lot of personalities out there. And you've done a great job of really summarizing the true reason why a lot of commercial bankers do what they do, which is it's really fun. And you're financing businesses that are integral to those communities. So I think that pulp deal, for example, that's such an important role. And you probably were all behind the scenes. And it's not like you were in the newspapers or anything, but from a value point of view, from feeling important, I think you probably felt awesome.
100%. Oh, Rob, you hit it right in the head. And remember that anybody that's listening to this that is in commercial lending, effectively, you want to help others. That's why you're doing what you're doing. And truly, if you understand what motivates you, it's now a matter of how do you get better at doing what you do? You figure out what it is. Every organization has its box, okay? And you have to be aware of that box. And if in your heart of hearts, you have aspirations to do private equity, mezzanine lending, private debt, like all the different terms, what you have to understand is that if you stay too long in your role, and I can speak because I did a lot of the hiring, especially at Calidus, and we built our little team. When I started, the place was 20, 25 million, 30 million bucks outstanding. I was employee number 3. We grew it to 1.8 billion in 7 years and went public. The key thing that I always had, and I drew issue, if someone is really good, if you stay in the same place and you live within a box and you're really good at living within that box, it's very difficult to transition to that next sort of area. So I always caution people and say, hey, look, depending on what it is you want to do, some people are happy. They get to a certain point in their career. They're making enough money. They're happy with their work-life balance and they're doing things, and that's okay. If you want to be one of the few, and my view is that when I look across Canada and you look into the number of specialty debt people that have the experience that I do, and there's maybe 15, 20 across the whole country, maybe 25 that have actually done it and sat in the chair and been successful and been able to get money to. What's the best day in a commercial banker's life? Oh, the day I close my deal. What's the worst day in a commercial banker's life? That same day, because now you got to get it back because you're selling what you have to have returned to you. And so one of the things that I would say is that as you're going down the path of your career, always keep your eyes open. Always be interested in what's going on out there. Don't be an active job seeker, because you can't be switching jobs every 2 years, because otherwise people aren't going to hire you. But always look ahead and try to figure out what it is that you might want to do. Where do you find your skill set? And this is truly my one key takeaway, is if you can figure out what you're good at, then you just do what you're good at, and you're not going to work because you love what you do. You're going to do what you love, and the hours are irrelevant because you're having so much fun. What I'm really good at is I can quickly assess. I'm fairly good at financial analysis, and I can understand people. And those things, you put those together, plus with my background and experience, it allowed me to move into a role which was one heck of a lot of fun. And I was paid very well to do what I was doing, but it was so much fun. I would have paid them to do it because I was enjoying myself so much. And like all the soft stuff and saving a town, it's things like that make you feel all warm and fuzzy. And plus you get money in your bank account. If, the folks that are listening, if you really enjoy the underwriting side of it, be the best underwriter there is and go down that path. And then if you're a portfolio person and you really prefer analyzing and doing the reviews and seeing what's happening and looking at the overall, there's a role for that too. The opportunities are there. Commercial banking, some people spend their whole careers there. Other people, they go commercial banking, maybe they go into asset-based lending. Maybe after asset-based lending, they can find a place in private debt. Maybe they go on that way. Somebody wants to go into private equity. So figure out what you're good at and then go after it and be nice to people. My last story I had, so across 30 years, I've worked at a bunch of different places. Do you know that I had a client follow me across 3 different organizations? People appreciate candor, timeliness, and honesty. And if you're a nice person, and truly, the biggest compliments that have been paid to me, you spent this time with me, you helped me, whatever, be it a kid that's trying to get further along in their career, being a kid trying to get into finance, be it a client that has just been told that their bank's kicking them out and that it's the bank's demanded, and spending the time dumbing it down and explaining it to them so they understand what is about to happen. Become that trusted advisor that people appreciate, that you're there to help them with no expectation of any kind of reward. They'll be the ones that will be there with you across your entire career and always be there to support you. Because look, in this world that we live in, and we all know that the banks are doing cutbacks and some people are getting jettisoned from places. I bumped into a former colleague. I hadn't seen the guy in 15 years and he was telling me his tale of woe. And I'm like, okay, what can I do to help you? And it's a really good egg when I knew him many years ago. So that's also a key thing. Keep up, be nice. And as you're rising through the ranks, be nice to everybody, because unfortunately, sometimes you come back down the ranks quite rapidly and you don't want everybody to turn their back on you.
Perfect. Listen, Mark, that's awesome. And a very Canadian thing to say as well. Be nice to people and treat them with kindness, because I'm a big believer that if you put good out into the world, good will find you as well. So I share that sentiment. Mm-hmm. And again, thank you for taking the time. You are a master of your craft. As you said, you're one of the top guys in the country when it comes to what you do. And you covered multiple different topics here in great depth, sharing a lot of stories and detail that I think a lot of younger bankers are going to find a tremendous amount of value in. If someone wants to connect with you and ask you more questions or have that type of mentorship conversation, what's the best way to connect with you?
Probably through email, and you can send me a note at mark@Wilk, W-I-L-K, capital, kind of simple, capital, group.com. And that's probably the easiest way. Trying to phone me, unfortunately, I spend my life on the phone. So you'll get a lot of, I'll call you back, and then 3 days later. So it's always best just to email. And if someone's looking for advice, it's my absolute pleasure. I know with a ton of people in various places. I've coached a number of folks, and it's like for no other benefit that when I grew up, my family wasn't in business, so I had to go forge my own path. And if I can help a younger person that's coming through this now, and it's either you're looking for advice or, gosh, Mark, I listened to you and Rob talking today and you mentioned this, and hey, I'm really interested. What would you do? Where should I focus? Or you want an introduction? My absolute pleasure.
Thank you for that gracious offer, Mark. Appreciate that. And you have a wonderful day. Thanks again for coming on the podcast.
Okay. Thank you, sir.
Thank you for listening to the Inside Commercial Banking podcast. I love creating this content and I hope that you found it helpful. Now, can I ask you to do one quick favor? It would help if you could share this episode with your colleagues and like and subscribe to the podcast. The more exposure we can get on social media, the more guests we can attract. I hope this podcast can be the go-to resource for aspiring commercial bankers and middle market professionals looking to learn and grow. So be sure to also check out the Finance Kid YouTube channel for more content on commercial banking and M&A in the middle market. Now, lastly, if you are based in Canada and you have a client that is interested in buying and or selling companies, I would love to connect with them. Please reach out to me over LinkedIn, and I'm more than happy to have a conversation. Thank you for listening to the podcast, and have a wonderful day.